I did a video on Mercado Libre stock a few days ago, and the video I think was very misunderstood. Like it got a lot of hate in the comments, a lot of people calling me names, and some of you guys really disagreed with my analysis, and a lot of you guys respect me and been watching me for a while. And I do listen to the comments, and I believe some of you guys were right. Like I don't believe I articulated my points well in terms of why I don't own MELI. I think I sounded overly bearish to the point that some people thought I was shorting MELI and I hate the company, which is not even true. I was only trying to explain the points that I believe are risks with this investment, as every investment has risks. There's no investment, no stock that's risk-free and that's just perfect. There's no perfect stock. Every stock has some risk. But I believe I haven't, articulated them the right way. And as they say in general, it's not really what you say, it's how you said it. And I believe I haven't done a good job in this video. So I'd love to make it up with a better video to explain why I don't own MELI stock and, some of the good things and the bad things with the company. So not just the bad stuff. And I'm also going to give you my valuation model and tell you if I believe the stock is undervalued or not. Now, MELI has been going down over the last year. It's down about 21% over the last year. So last report was absolutely amazing again. The company grew about 36% FX neutral in GMV. Items sold have increased a lot, about 45%. And the company, again, it just keeps on growing. This is a pretty massive company in terms of sizing in general, and the revenues are, in the billions of dollars. And every year I'm like, MELI is going to start to decelerate. Like, this is not sustainable. Then I look at the report and they grow 30, 40, and 50%. I mean, it's been really shocking to a lot of people that have been following this stock, because most companies, especially in e-commerce, they normally, whenever they're growing 50 and 70%, that's like their peak, and then they start to decelerate. But this company has been putting up those growth numbers years after years, and it's been really amazing to watch. Now, the company's unique active buyers, which is how many people are on that marketplace, it's about 89 million people, and it's been growing steadily, 26% quarter on quarter with no signs of deceleration. Same thing in the fintechs, their fintech business, where they provide a lot of loans, they consumer credit, and they're even getting an asset-backed related securities and other things. Well, this one is growing 30% year on year to about 88 million people. This is a lot of people that MELI can cross-sell, they can monetize them, and it really has a lot of network effects, because MELI is giving them credit. They use the credit to buy something from MELI, which also benefits MELI. Then they can extend them more credit, and then MELI benefits as well. So they have a pretty amazing flywheel that's working really, really well for this company, especially in Brazil. Now, if we look at the health of the portfolio, about 18.7% of those loans are 90 days plus past due. This is really massive, guys. Now, I know in Latin America, the standards are different in terms of lending, and there's a lot of different things, but I still believe 18.7% should be some kind of a risk that should be monitored. Now, the less than 50 to 90 days past due have ticked down about 1%, which is a good sign, as those loans are more near-term, and we can see them much clearer as a short-term metric versus the other loans, which are a little bit lagging. They are 90 days plus past due. But, this is still an improvement on this part. But again, the 18.7%, I personally think it's a little bit high. Now, despite them, 18.7% of them not really, you could say, being past due over 90 days plus, the company is still putting up about 20.7% net interest margin. So even after all those losses, the company is still making a 20% margin on this book. And that's really amazing for the company. And what's really important to monitor is if they can actually keep it up. So if they can keep up 20%, it doesn't decelerate to 19, 15, 11, 10%, then you could say this is a very bad sign for MELI, and those losses are starting to catch up to them. But so far, they have been able to maintain 20% profits on those net interest margin, and that's really good for the company. Now, in terms of the company's margins, their margins have been decelerating. Operating margins decelerated from 12% to 6%. Net income margin decelerated from 7% to 4.6%. And I think this is a big reason why the stock has been going down. Now, if we look look at what led margins to decelerate, it was mainly bad debt, and those are mainly provisions for the bad debt. So it's a 2.4% impact, or I think it's like 952 million, but not the whole thing is gonna like be people are not paying, but they have tight credit standards, so they account for more losses than what will most likely occur. So that also affected margins. But the big one that really affected margins was the 4.7% in the cost of goods sold. And the main reason for that is because MELI has lowered the free shipping rate in many countries like Brazil and others. Now, the management team said that they're doing it for long-term purposes, so they are investing for the long term. And this is something that's amazing from a growth company. I think all growth companies should be focused on maximizing growth, and once they win, once they establish the platform, then they can focus on monetizing the members. But my main concern that I tried to explain in this video is that MELI is doing it for the long term, but they're also doing it because there's some competition that they are facing. And this is not me saying it again. This is from many articles, from many analysts that have downgraded the stock over the last year. And that was their main concern. It was the competitive landscape. And this is what I was trying to explain. I was not looking at stock prices and justifying why it's going down. I was looking at the sentiment in the market. Why is the stock going down? Why people are likely selling it? And the most likely reason that I found, in general, based on my research, is, fears that MELI is doing this because they're facing competition. And this is what this article says. It says Mercado Libre cuts free shipping minimums to 19 real amid rival pressure. It says industry insiders view the move as another response from Mercado Libre to fend off foreign competition, particularly from Shopee, now Brazil's second largest marketplace. It also comes as the company seeks to strengthen its position following the arrival of TikTok Shop in May. Mercado Libre hopes to boost sales of items left abandoned in cars, typically at low-priced goods, a segment dominated by Asian players like Temu and Shopee and AliExpress. With a high free shipping threshold, the company risked losing competitiveness. So the company did lower the shipping threshold. This is partially why cost of goods sold were, the cost went low. And I think this is the right thing to do because it will help the company, you could say, squeeze out the competitors that are offering free shipping coupons and other things, because MELI has the platforms, they have the ecosystems, they have the logistics, much more advanced than Amazon, much more advanced than Shopee. But my main concern with this whole thing is that the management team, they said they're doing it for the long term. But then if Shopee is the second largest one in Brazil, backed by C Limited, and Shopee is investing in logistics and Amazon is invested in logistics, that's a concern for me that this battle will go on longer than what people believe. And if it does go on longer than what people believe, then maybe Mercado Libre's margins will likely sustain at about 4 to 4.5%. So it's not like if MELI lowers the shipping rate, they're going to scare away Shopee, scare away Amazon, and then once all the competitors are gone, then they can raise it back to 10%. This is possible, maybe if they find efficiencies like Amazon did and they do a lot of things. But my main concern was that they're not just doing it for the long term, but they're doing it because there's some kind of competition in Brazil that's forcing them to lower the shipping rate. And that was a little bit of a concern for me. The second concern was also in terms of, you could say, the debt in general. Now, yes, they are having about 20% net margin and they're doing all these things. But I personally don't really like companies that are involved with credit in such a major way. Like with MELI, it's about 19% past due. And that's not really normally a risk that I like to take with a lot of the e-commerce players. But as Howard Marks says, it's not what we buy, it's what we're paying. Now, if we look at how much we're paying for MELI, we're paying about 46 times forward earnings. 46 times forward earnings might look overvalued, but the company is growing earnings per share and is expected to grow 45% in 2027 and 42% in 2028. So this is trading below one PEG ratio, one price to earnings growth. For a great company like MELI, I think this is undervalued in general. Now, if you look at my valuation model on MELI, I kept the analyst estimates of 40% and 40% for the next 2 years. Then I priced in a deceleration to 35%, 30%, 25%. Now, MELI might be able to maintain 40%, but I'm still pricing in a deceleration. Now, if the growth decelerates, the multiple will likely decelerate as well. So I took the multiple down from 47 times trailing earnings to about 25 times. I also think it's fair. The current price of MELI is $1,885. The future price in my estimate is $4,300. So that would be about an 18% annual return, or about a 128% on the upside from today's price. That's not really bad at all for a company like MELI. And if the multiple was higher, let's say, 35 times, then the stock could compound 25 to a 26% annual return from today's price. So I'm not really bearish on MELI. I think it's presenting a great setup in general. If you're willing to take on, you could say, the Latin American risk, you're willing to take on the loan book, you're willing to take on all those risks as a competitive, landscape relative to maybe Amazon as an alternative, then MELI is a great investment. It's well priced for a lot of those things, and it's primed to do really, really well. But for me personally, all I meant is that I'm just not willing to take those risks, and I would rather invest in Amazon or invest in something else. So that was really my opinion on MELI. I hope I was able to articulate it a little bit better, and I tried to highlight some of the risks, as I believe every investment has some risks or some concerns or something around it. So I really hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.